Hey everyone, welcome back. Ready to unlock the secret to building a $1 million portfolio?
$1 million portfolio. That sounds intriguing.
Well, it might not happen overnight, but dividends could be the key. Today, we're doing a deep dive into the world of dividends.
Ooh, dividends. I like the sound of that already.
We've got some awesome sources lined up, classic investment books, practical guides, even a story about Einstein.
Einstein. Okay, now I'm really
I know,
curious.
right? And the best part is, by the end of this deep dive, you'll know exactly how to make dividends work for you.
Let's do this.
So first things first, what exactly are dividends?
Well, think of it this way. When you buy stock in a company, you're basically becoming a part owner.
Oh, like a tiny slice of the pie.
Exactly. And if that company is doing well and making a profit, they might decide to share some of that profit with their shareholders, the people who own a piece of the company.
Ah, so it's like getting a little bonus for being a loyal owner.
Exactly. And that bonus is what we call a dividend. It's a share of the company's profits paid out to you, the investor.
Sounds pretty sweet. And all of our sources seem to agree on that basic definition. It's like getting paid just for owning the stock.
Right. But here's the thing. Not every company pays dividends.
It's right. Our sources point out that typically it's those well-established, financially solid companies, the ones that are confident about their future earnings.
Exactly. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These are the giants, the ones that have been around for ages, and they have a long history of sharing their profits with their shareholders.
Makes sense. It's
Yep.
like Warren Buffett says. It's like planting a tree. You nurture it, watch it grow, and eventually it starts bearing fruit. Yeah.
Spot on. That's the beauty of dividend investing. You're not just looking for a quick buck. You're looking for long-term sustainable growth. You're looking for companies that are built to last and can keep those dividends flowing.
Okay, I'm starting to see the appeal here. But let's talk about the advantages. Our sources highlight three main benefits of dividend investing: regular income, long-term growth potential, and the power of compounding. Can you break those down for us?
Absolutely. Regular income, that's the beauty of dividends. They provide a steady stream of cash flow, like a paycheck from your
Oh,
investments.
like a little bonus every quarter or so.
Precisely. And this can be particularly appealing for folks who are looking for a source of passive income, maybe to supplement their retirement or just to have a little extra cash on hand.
Right. And then there's the long-term growth potential. Even if the stock price doesn't go up dramatically, those dividends can really add up over time,
Exactly. You're essentially getting paid to hold onto your investments, and those payments can be reinvested to buy even more shares, further accelerating your growth.
which leads us to the magic of compounding, right?
The snowball effect.
Yeah.
It's like Einstein said, it's the eighth wonder of the world. Compounding is when your earnings start generating their own earnings.
Whoa, that sounds almost too good to be true. So if I reinvest my dividends, those reinvested dividends then earn more dividends. It just keeps growing and growing.
Precisely. It's the snowball effect in action. And the longer you let it roll, the bigger it gets. It's a powerful strategy for building long-term wealth. But, and this is a big but,
Okay, I sense a but coming. What's the catch?
well, while dividends are fantastic, there are a few things to watch out for. One of the biggest ones is getting lured in by high dividend yields without digging deeper.
Ah, the classic high yield trap. So a high yield doesn't automatically mean it's a good investment.
Exactly. Remember, the yield is just a percentage. What's more important is whether the company can sustain those payouts over the long haul. You want to look for companies with a solid track record of consistent dividend payments, ideally growing over time.
That makes a lot of sense. So it's about finding a balance between a decent yield and sustainability. It's like you always say, do your research right.
Always. Check out a company's payout ratio, which tells you what percentage of their earnings they're paying out as dividends. A high payout ratio could mean they're stretching themselves thin, which might not be sustainable in the long run.
Wow, I'm learning so much already. So what about for those of us who want the benefits of dividends, but maybe don't have the time or expertise to analyze individual companies? Our sources talk about dividend funds as a great option. What's the deal with those?
Dividend funds are fantastic. Think of them as pre-packaged baskets of dividend-paying stocks. It's like having a professional fund manager handpick a bunch of great dividend-paying companies for you.
Oh, so you're not picking individual stocks, you're investing in the whole basket. It's
Right.
like one-stop shopping for dividends.
Precisely. And that diversification can be a huge advantage. It spreads your risk across multiple companies, so even if one company hits a rough patch, it's less likely to tank your entire portfolio.
That makes a lot of sense. So instead of putting all your eggs in one basket, you're spreading them out across a bunch of different dividend-paying companies. But doesn't that mean you have less control?
That's true. You're trusting the fund manager to make the right calls, and there are management fees to consider. But for folks who prefer a hands-off approach, dividend funds can be a great way to simplify dividend investing.
Got it. So whether you go with individual stocks or funds, it seems like the real magic of dividends happens over time. One of our sources talks about legendary investor Peter Lynch. He had this amazing piece of advice. The real key to making money in stocks is not to get scared out of them.
Such wise words. Patience is key in investing, especially when it comes to dividends. It's a long game, not a get-rich-quick scheme.
Absolutely. One of our sources used this great example. Imagine you invest $10,000 in a company with a 5% annual dividend yield. If you reinvest those dividends year after year after 10 years, you'd have over $16,000. And after 20 years, over $26,000. That's the power of compounding in action.
Incredible, right? It just goes to show that consistency and patience are key when it comes to dividend investing.
And it's not just about the numbers. It's about building that solid financial foundation, as Benjamin Graham said. Investing isn't about beating others at their game. It's about controlling yourself at your own game.
So true. It's about discipline, strategy, and focusing on the long term.
Like running a marathon,
Right.
right? Steady and consistent wins the race.
Exactly. So how can our listeners take all of this and actually get started with dividend investing?
Well, our sources offer some great practical tips. First off, they suggest looking into dividend aristocrats.
Dividend aristocrats. Sounds fancy.
This is a bit of a fancy term,
Okay.
but it simply refers to companies that have increased their dividends for at least 25 consecutive years. These are the companies that have proven their commitment to sharing profits with their shareholders.
Ah, so they're the royalty of the dividend world.
Exactly. Think companies like Coca-Cola, Johnson & Johnson, or 3M. They've weathered storms, recessions, and all sorts of economic ups and downs, and yet they've consistently increased their dividends year after year.
Impressive. So step one is to do your research on these dividend aristocrats. What else should our listeners consider?
Well, beyond just looking at a company's dividend history, make sure you understand their business, their competitive landscape, and their future prospects. Are they well positioned to continue growing and paying those dividends?
Right, remember that payout ratio we talked about earlier? That can be a really helpful indicator of a company's financial health and their ability to sustain those dividend payments.
Exactly. And next up, our sources emphasize the importance of setting clear goals. What are you hoping to achieve with your dividend investments? Are you looking for a steady stream of passive income to supplement your retirement? Or are you more focused on long-term growth?
Defining your goals from the outset will help you choose the right investments and stay focused on your long-term plan.
Absolutely. And finally, our sources recommend taking advantage of online tools and resources. There's so many websites and platforms out there that offer in-depth information on dividend stocks, ETFs, and mutual funds. You can find data on yields, payout ratios, historical performance, and even simulate potential returns based on different scenarios.
Technology has made it so much easier to research and manage your investments. And let's not forget the good old-fashioned power of reading. We've got some fantastic book recommendations in the show notes.
Oh, yes. If you want to dive deeper into value investing and building a solid foundation for your financial future, The Intelligent Investor by Benjamin Graham is an absolute must-read. It's a classic for a reason.
And if you're looking for a more modern, practical guide to dividend investing, check out The Dividend Growth Machine by Nathan Winkelpleck. He breaks down the strategies and principles in a clear and easy-to-understand way.
And for those who are interested in picking individual stocks, One Up on Wall Street by Peter Lynch is an excellent choice. It's full of insights and anecdotes from one of the greatest investors of all time, and he makes a strong case for the power of individual investors to outperform the pros.
So many great resources to learn from. The key is to keep learning, stay informed, and never stop exploring.
Couldn't agree more. This deep dive has been an awesome reminder that dividends can be a powerful tool for building wealth over the long term.
So let me leave you with this thought. Imagine yourself 10 years from now. What would your financial life look like if you had started your dividend journey today? What goals could you achieve?
That's an excellent question to ponder. Remember, all the resources we've mentioned, including links to those books, are waiting for you in our show notes. Go check them out, do your research, and most importantly, take that first step.
Happy investing!
We'll see you next time.